Warning of a global financial crash. I have all the details and what you need to be aware of right here in the video, so let's get right into it. Alright, the warning bells are ringing when it comes to a global financial crash. So in this video, I want to bring you up to speed as far as what's going on and showing you some of the major cracks that are starting to emerge all across the globe in some very important economies. In fact, as of right now, some of the economic numbers that are being released all across the globe in some of these very important economies are showing the worst economic numbers that we've seen since 2008. Do you remember what happened in 2008? Oh yeah, we all do. The last major crash that we've seen, with the exception of the early crash in early 2020 as a result of COVID. So let's get into it and talk about some of these economic numbers and what we're starting to see all across the globe right now and how we're starting to see this economic situation unravel right before our very eyes. Let's quickly turn over to some of the European countries right now. So let's talk about a couple of the European countries, including Germany and Italy to start. Now these two countries alone are showing PMI numbers, as in Purchasing Managers Index numbers, below 50. Now let me give you a quick reading and breakdown on the PMI index. Basically what this index is an index between 0 and 100. Any readings above 50 show economic expansion, meanwhile any readings under 50 show economic contraction. Well, these two very important economies are already showing PMI numbers below 50. In other words, their economies are contracting in a pretty major way. That is not a good sign, right? We want to continuously see economic expansion all across the globe. Even if it slows down a little bit, that's fine. There's nothing wrong with the economy slowing down a little bit. But when we start to see economies contracting, that's when we really need to start paying attention, because that is not a good sign, right? That is a classic sign of a recession basically on our doorstep and going to be arriving at any given point. So, and again, like I've said before in many different videos, we need to continue watching everything all across the globe and right here in the United States as well, because everything is highly correlated. Just like a big machine, right? If all of a sudden you have a big machine and a chain breaks or a belt breaks or a gear strips out, something like that, it'll take down the entire machine. The same thing goes with the United States economy as well as the global economy, right? It's all very important. It's all highly correlated. Anyway, so those two countries is what I wanted to share there. Now let's quickly talk about the UK, the United Kingdom. So some new information being released there is suggesting by early 2023, so honestly, not that far from right now, the United Kingdom is likely going to be facing 13% inflation. And sometime in mid-2023, they're projecting that to see at least 18 or 19% inflation in the United Kingdom. That's huge. That's massive, right? For a big economy like the United Kingdom and a well-developed economy like that, that is huge. That is not a good sign. Again, in some of the European countries like Turkey, for example, we've been seeing inflation around 70% for several months now. Again, not a good thing, right? So a lot of these cracks are starting to emerge. Now let's quickly go over to China for just a second and talk about this economy. Now, if you haven't been paying attention to China, that's okay, but let me tell you some of the things that are going on over there. As a result of the COVID lockdowns they've been dealing with basically throughout the entire year of 2022, in fact, they haven't been in a lockdown in quite a while, but for the first half or so of 2022, China did go in and out of COVID lockdowns constantly, right? They were locked down quite a bit during that time. However, as a result of that, we're starting to see the Chinese economy contracting in a major way. In fact, the real estate market in China is not a good thing, right? The real estate market over in China is like basically plummeting right now. It's basically falling off a cliff. So, not a good sign as well, because China is a major trade partner of the United States. And again, not saying that it all relates to the Chinese real estate market, things like that, but at the end of the day, it's all highly correlated, just like I've said so many times before. Now let's quickly talk about the United States and some of the things that are going on here. Now we need to take all this into consideration. And again, the economies that I talked about right here in this video so far, as in Germany, Italy, the United Kingdom, the Chinese economy, these are just some of the major economies around the globe right now. But don't get me wrong, there's many other economies out there right now that are not doing so well. But these are some of the major ones that we want to keep an eye on. And again, there's many others out there as well. But again, I can come back in separate videos and talk about those in greater detail, but I'm just simply saying these are a couple examples of showing some major cracks starting to develop in the global economy. So now let's quickly talk about the United States. Where do we start? That's a good question. Let's quickly talk about the real estate market since we just got done talking about that with the Chinese market as well. The real estate market basically over the last 2 years from pretty much mid-2020 until mid-2022 has been on an absolute tear, right? It's been going up very, very fast. Supply has been relatively low. Demand incredibly, incredibly high. People bidding prices up on virtually everything. Multiple offers coming in on virtually every single property. Any property that hits the market is pretty much sold within record amounts of time. New record highs in real estate prices in the United States. In fact, as of just maybe a couple weeks ago, the new national average for a real estate transaction was $413,000. That's the highest we've ever seen as a national average for real estate, right? For a single family home. That's huge. Usually it's significantly below that, but this was as of a couple weeks ago, the $413,000. So again, as of right now, we're starting to see the real estate market in the United States cooling down substantially. In fact, rather than seeing prices increasing every single month on real estate, we're actually seeing prices plateau out. And in some regions all around the United States, we're starting to see real estate prices actually going down. We're starting to see price cuts. That's, again, a pretty good sign if you want to see some prices come down on real estate. And if you're looking to buy something, again, this is what you want to see here, right? Some prices coming down. However, if you're on the other side of the transaction and you want to be a seller, sorry, you probably missed the top of the market, right? You probably missed your opportunity to sell into a very, very strong market. Don't get me wrong. The real estate market is still very strong right now, but it is starting to cool, and we're starting to see it cool kind of relatively fast. Now, why? Did somebody just flip a switch? Well, yeah, they kind of did. In fact, it was the Federal Reserve. The Federal Reserve flipped a switch called raising interest rates very aggressively. So as of right now, the rate on a 30-year fixed rate mortgage is sitting at about 5.25%, give or take a little bit, but that's about where it is as of right now. Now, to put it into perspective, when we started 2022, the interest rate on a 30-year fixed rate mortgage was sitting below 3% at about 2.86%. That's massive. We're almost double what it was just about a handful of months ago at the beginning of the year. So interest rates being sub 3% to now say 5.25%, that's huge. That's pushing a lot of people out of the real estate market because the buyers that are coming in are simply unable to afford what they once could. So somebody who could afford, let's just say, a $200,000 house at the beginning of the year can no longer afford a $200,000 house unless they bring in a huge down payment, right? So there's a couple different ways that could happen unless the person's income has increased substantially, or if that person's going to bring in a large down payment into the purchase, they can no longer buy that $200,000 house because interest rates have gone up so much, the payment has increased substantially from what it was just at the beginning of the year on that one simple transaction of a $200,000 home. So again, this is pushing a lot of buyers out of the market right now. Therefore, the prices on these homes need to come down to find the demand that is out there in the marketplace. So just one little factor that we need to consider. Now, next, going forward, we know this much as well. The next FOMC meeting, it's already been talked about that the Federal Reserve here in the United States is likely going to be raising interest rates by probably another 75 basis points. In fact, this is what some of the big banks out there and analysts are actually anticipating right now, is that the next one could be another massive rate hike of 75 basis points. And again, this is going to directly translate into any types of money that you're borrowing right now, unless you have a fixed rate on anything, but generally any type of loan or home equity line or personal loan or anything that you want to be, that you're holding right now or that you might want to lock in, is going to be going up once again. Same thing goes with mortgages. Even though mortgage rates are not directly tied to what the Federal Reserve is doing, it's all based on interest rates. And therefore, if the Fed is going to raise interest rates, it's going to translate into interest rates rising across the board on virtually all debt products. So again, unless you have a fixed rate mortgage, you're going to be totally fine. But if you're locking in a fixed rate mortgage after they raise rates once again, then just guess what? You're probably going to be paying an even higher interest rate. Now, what is the whole purpose behind this? The whole purpose behind this is for the Federal Reserve to raise interest rate and decrease the appetite or the demand for debt. As in, the more expensive that debt gets, the less that we want to borrow money. Because why would we borrow money when we're paying 5.25%, 5.5%, or even higher interest rates on that money, right? Especially when just say 9 months ago or even longer ago, late last year and early this year, we were looking at interest rates being below 3%, right? So money has gotten way more expensive. As a result of that, less people, as in individuals, and less businesses want to borrow money on that because it's more expensive, right? So people borrow less money, less debt being taken out, less money going into the economy, stimulating the economy and keeping it red hot, right? So that's the whole idea behind the Federal Reserve. Raise interest rates so that we, the consumer and businesses, stop spending as much money. That's the whole idea behind it, right? So at the same time, we're starting to see a lot of large corporations out there announcing large layoffs. In fact, we just heard from Ford that they're laying off 3,000 people, among so many other companies out there right now, laying off thousands or hundreds of people. So a lot of large corporations. However, this does not take into consideration all the small businesses out there right now that maybe have 5, 10, 15 employees that are letting go or laying off, say, 50% of their workforce, or say a third of their workforce, 33% of their workforce. Again, it's not taking into consideration all of the smaller businesses, but rather we're hearing about all the big ones, the 3,000 from Ford, the hundreds out of Peloton, or all these other places out there. In fact, not only that, these big banks and institutions, loan processors for mortgages, they're laying off huge divisions of their mortgage branches because nobody's taking out mortgages anymore, right? The demand out there for mortgages has dried up substantially from what it was over the last 2 years. Therefore, you don't need an office with 100 loan officers. They can get by with 25 or 30 these days. So they're laying off huge sections of their loan divisions because nobody really needs a mortgage anymore. Some people certainly do, but the demand there is just not there anymore, and it's only going to get worse as the Federal Reserve continues to raise interest rates and rates on 30-year fixed-rate mortgages, and of course, all mortgage products continue to go up, right? So we're starting to see layoffs, we're starting to see job cuts, and we're starting to see this reflected in the weekly initial jobless claims numbers as well, as these have been trending higher over the last several weeks here, a little bit more and a little bit more. Every single week we're starting to see more and more people being laid off. And more people, applying for unemployment benefits. So these are some of the factors as well going on here in the United States. Let me share with you another study and another report that was recently released. A new study was released polling economists in the United States here, and 72% of economists are suggesting that we are on the cusp of falling into a deep recession in the United States. Now, here's the thing. If the global market and if the global economy falls into a recession, guess what the United States is going to do? Do you think we're going to be spared? No, it doesn't work that way. Not really, right? Maybe in a rare instance, the canary in the coal mine type of situation, we might be spared, but realistically, we're not going to be spared. We're going to be just like every other country. All these other major economies falling into a recession, the United States is going to be right there with them, falling into a recession as well, and that is exactly what the analysts and experts are actually anticipating. In fact, by the fourth quarter of 2022, analysts and experts are suggesting that we're already going to be in a pretty deep recession at that point. So again, it's all kind of coming home to roost here. We've been talking about this for a very long time. But here's the fact of the matter. When it comes down to the United States economy, or any economy for that matter, it takes a very long time to turn this thing around, right? So if the economy is booming and going really well and things, are doing just great, it takes a long time to slow that down, to finally pivot and then reverse and go in the opposite direction, right? Just like the analogy I've used before. You have a huge freighter out on the ocean, right? Maybe coming from, just a huge freighter, right? A huge freight ship moving stuff out on the ocean. That thing's cruising at however fast those things move. Honestly, I don't really know. Let's just say 20 knots. I don't know. Is that fast or slow? I don't really know. Let's just say it's cruising at 20 knots. All of a sudden, the thing needs to slow down and pivot and go the opposite direction. Does it just immediately stop like a motorcycle and pivot and then turn around on a dime and then just go the opposite direction? No, it takes a very long time to slow it down, bring it down to a halt, and then pivot that thing and turn it all the way around, right? And then get it moving again at 20 knots in the opposite direction. It takes a very long time in a large distance. The same thing goes with the economy, right? Takes a very long time to slow it down, finally slow it down and stop, pivot, and then bring it back the other direction and get it moving in the opposite direction in the same speed at what it was once going, right? So anyway, same analogy goes for the economy, right? So that's why we're going to continue watching all this stuff very closely, because generally the Federal Reserve overshoots on just about everything, right? So they go too hot on the upside and they go too much on the downside. So we're probably going to see that happen once again, even though they're raising interest rates very aggressively right now. Again, they're probably going to cool this thing off a little bit too much, and it's going to go down further than they anticipate. But that would be also providing an opportunity, because at that point, the Federal Reserve will come in and say, hey, we're going to do quantitative easing, in other words, called printing money, and then it's going to provide an opportunity to get into some markets like the stock market, things like that, and watch for all that free money to come in and start piling in and driving prices significantly higher on equities. So a few things that I'm watching here. And again, as always, we got to watch the stock market as well, because again, that's another key factor here, because if the stock market rolls over and crashes and burns like it's probably going to in a pretty big way here, as a result of that, are people more confident to go out and spend money and stimulate the economy with their savings and their retirement accounts and things like this when the economy is crashing and their savings and their retirement accounts are crashing? No. People are far more fearful than that, and they say, I'm going to contract right now. I'm not going to spend anything. My account just went down by 20%, by 40%. I don't want to spend any of it. I don't want to do anything. I just want to sit here because I'm too scared to spend any money. I need to make sure that I'm good to go for the next several months or the next couple years, because in the heat of the moment, it feels like something that's never, ever going to fix, right? It feels like it's something that's going to go on forever and ever. So anyway, in this video, I wanted to break it down for you, let you know what I'm watching all across the globe right now, some of the major economies out there, like the examples I gave here in this video, including the United Kingdom, Germany, Italy, the Chinese economy, as well as the United States right here, and just kind of see what's going on here. It's all highly, highly correlated. So if we see a couple of the major economies like Germany and Italy and possibly the United Kingdom going down, guess what? Guess what's going to happen in the United States? We're going to follow right along with that. So again, I don't want to instill fear in anybody here, but I want to be here to be proactive and let you know what is likely coming here. The numbers are showing us this is what is coming. And again, could it be another 3 months? It easily could be. Could it be 6 months? It could be. It's a very slow process, but when things start to happen, it starts to unravel pretty fast, right? We've seen it happen before. 2008 and early 2020 could be very good examples to see how quickly things can really unravel when it starts to happen, right? So anyway, hope this video helps you out. Again, a major global financial crash warning. I want to keep you updated, and who knows, maybe things just get better and fix themselves. Doubt it. But again, you never know. And again, I will continue to keep an eye on everything right now. I will keep you posted as I do get more details. So please make sure to subscribe down below if you haven't done so yet. Share the video with your friends, family, social media, and go back and check out some of the other thousands and thousands of videos here on the channel. I'm here for you in any way that I possibly can be. Please enjoy your day. Until next time, have a good one. I hope this video helps you out to better understand what is actually going on right now with the global economy as well as the United States economy. Enjoy. I'll catch you again later in the next video.